Hey traders and investors, that's a little bit of a video clip of a bit of a joyride I took this weekend in my Mercedes through the beautiful landscape, beautiful colors this year. It's so inspirational to be out in nature and a recharge heading into a new and very busy week this week. So let me get right to the point. Two major points I want to make as we start a fresh 5 session set, as a former mentor used to say. Number one, we have earnings. Major earnings week for large cap tech. Google, Amazon, Apple are just some of the names that are reporting. But before we look at even that, we have to look at the S&P 500 and implied volatility, and I'm starting to see some seriously concerning signs. So here's the chart of the S&P 500, and we have the S&P on top, so the SPY ETF. At the bottom, we have the VIX, which is essentially representing the implied volatility, or the fear level for of options in the S&P 500. And specifically, what I want to point out to you guys is, is this point here. So you can see that coming into this Brexit vote, which was in June, this past June, not that long ago, it seems like an eternity ago, but just past June, within, let's say, 23, within literally just a few days, or let's call it 2 weeks to be safe, on the safe side, before I get a nasty email from someone. Within about 2 weeks before Brexit vote came about, the VIX was at very low implied volatility levels. And the closer we got to the VIX, the more these implied volatility levels more or less started to rise. It's a similar situation right now with the election now. The US election is on November the 8th. It's about 2 weeks from today. Today is October the 24th as I'm recording this. And you can see the VIX is at about 13. Seriously? I mean, I'm not thinking the world's going to fall apart either after elections. For all I know, it could, but that's not my base case. But the VIX at 13 implies zero panic or zero concern, if anyone, about elections, and I don't think that's realistic. So I think here, one thing I'm going to start doing this week is buying some puts in the S&P, maybe even some calls, and kind of see if we can play this rise of implied volatility that I think should happen at some point over the next week or two as we get closer to the election. So that's point number one. And now point number two, again, going back to these earnings, Apple reports tomorrow, the 25th, and then Amazon and Google, I believe, are reporting like the 26th, 27th of October. Two charts I want to focus on. Number one, and very simply, I pinned the S&P 500, so the SPY ETF, in red here versus the QQQ, the NASDAQ 100. You can see more or less they kind of move together. We're seeing a little bit of a separation right now. The S&P underperforming the QQQs, the NASDAQ 100. And this is not yet as extreme as I'm going to show you guys in 1 second on the next chart. But for a little bit of context, basically what it's telling us is that the S&P has basically started topping out in late 2014, really, but really 2015 is when the S&P started losing upside steam, as I should say, not topping out because obviously we made a new high this year. But the NASDAQ 100 kind of more or less continually started sort of pushed higher in relative terms, much better so. So basically it has to do with tech, large cap, heavy tech, like the names that are going to report this week, outperforming. Now the issue with this chart is that the S&P 500 has a lot of tech. It's like got 20% tech, and a lot of these big heavyweights like Microsoft, Apple, Amazon, Google are a good part of the S&P 500. So you don't see the divergence as well here. If we look at this chart, though, you can see this is the New York Stock Exchange Composite, which is what is this, in red? I believe it is. It's got to be in red. Yeah. So the New York Stock Exchange Composite is in red. This is a much wider basket of stocks in the S&P. And what I did here is I plotted. You can see Amazon.com, Google, and Facebook. That's again representing some of these large cap tech names. I plotted those names against the NASDAQ, the New York Stock Exchange Composite. You can see here, for one, not only is the divergence more notable. Again, these are the large cap tech stocks up here, and this is the NYA composite. But also you can see that very clearly that index topped out last year, while some of these stocks really just continued pushing higher. So meaningful divergence here. If you want to be cautious, because it's not going to take much for some of these stocks to disappoint a little bit and cause a fairly decent sell-off. Again, it's not my base case necessarily, But I'm telling you, it's not going to take much for these stocks to start dropping, for people to take profits if there's any sort of sign of buyer exhaustion and maybe not as rosy an outlook in some of these stocks. And that in turn, because of the large makeup of or had the fact that these stocks have basically held up the broader market, if they start pulling back, then the entire index could start rolling over. So I think it's time to be a little bit more cautious here. Buy some puts in the S&P at the very least. Implied volatility is very low. Hope this makes sense, guys. Good luck to you out there this week. Any questions, please leave them down below in the comment section. Please subscribe to the channel. Help me move from the YouTube ranks, and I'll see you in the next video. Take care.